Hello and welcome to MF Corner. I'm Sumaira Abdi. Let me start off by wishing all our viewers a very happy Diwali and a very prosperous New Year. So Diwali is synonymous with Goddess Lakshmi and wealth, and therefore a good time also to take stock of how things have panned out over the last few years. In our case, over the last 25 years. It so happens that 26 mutual fund schemes now boast of having a vintage of over 25 years. But how have the returns been? Have you, the investor, made money? Could you have done better by investing elsewhere? And which have been the performers and the laggards? Joining me is Feroze Azeez of Anand Rathi Wealth. Hi Feroze, thanks very much for joining us in the studio and for making the trip here. So I want to first start off by asking you, exactly how performance has been over the years, which is a good way to analyze this metric.
Sumaira, of course, the performance now, if you have data of 26 funds into 25 years, that's 26 into 25. Those many numbers of years of performance exist for you to mathematically analyze whether equity has done well first, have mutual funds actively managed done well, and have people made money, right? All three are three separate questions. Have investor made so much money? The answer may not be too much. Have the funds delivered beautifully? The answer is yes. Why is there a difference in investor return and the fund return? Because investors like to fidget with their investments, especially on the equity side. So equity has done well. Funds, active management funds have done immense justice. And 25 years is not small periods, right? We're speaking of almost the evolution of Indian capital markets. And then you're speaking
about... And the
entire
history of the mutual fund industry pretty much.
Correct. On the private sector side, in 93, 94, there was privatization. Of course, the industry is a little old with UTI and stuff, and private sector entering the mutual fund industry is a very important inflection point in the mutual fund industry history. So I'm very excited to look at the numbers for 10-year investors. 1-year investors have been disappointed. 2-year investors have been disappointed. As a stretch, even 3-year investors, some of them could have got disappointed. But 10-year investors have done phenomenally well, to say the least.
Okay, so let's look at your data. What is the reading that you have got, or what's the read-through if you look at returns over the last 10 years?
See, if there were 26 funds, let's assume somebody invested in all the 26. See, I don't want to apply mine, for example, and I want to distribute my 100 rupees, practically 4 rupees per fund. What would have been the outcome if you did this every single day and held it for 10 years? See, you could have invested on one day, sold after 10 years. I could have invested on another day and sold after 10 years. What's common between you and me is the 10-year investing period. And if you have invested in all the 26 funds, the average return has been 16.7% compounded. The median return is 50% of them getting more, 50% of them getting less. That's called the median. That's 16.1. Both median and mean are above 16%. That's one. Second, the most unluckiest investor. See, risk is all about understanding when everything goes wrong, what happens, right? So the unluckiest investor, this is where the key lies. And that's where India needs to correct its perception with respect to equity mutual fund investing. The worst 10-year investor has made a 4.5% compounded return, which means none of the investors, the unluckiest one, still made 4.5%, which is greater than a savings bank account.
So this whole notion that you can lose money over longer periods, that thing neutralizes because the longer term trend is always up.
Correct. See, if you can visualize being the unluckiest and still it is palatable to your mind, then you have understood risk. Of course, the next 25 years could be very different. Okay, I'm not saying the next 25 years the unlucky investor might just get 2%. But 4.5% being in the positive zone for the unluckiest guy is a great start. And people generally have a perception when they hear this mutual funds are subjected to market risk. That's an English statement. I'm trying to quantify that English statement into mathematics. They're subject to market risk, but if you don't fidget with it for 10 years, you will still going to be in the positive zone. At least 25-year history says so.
Okay. Feroze, why have you chosen to compare these funds on a 10-year period and not since inception? I mean, is there any reason behind it, a 5-year, 10-year?
Yeah. See, I am not just considering one 10-year period. I am considering every 10-year period. For example, if a fund starts...
10-year rolling returns.
10-year rolling return. See, if I take since inception, you just get an experience of one investor. Because you could have invested on the day of inception, and held it till now. So how many experiences are we speaking about? We are speaking of one experience. But if you do 10-year rolling, you're speaking of thousands of different investors' experiences. That's when you can find out who's the luckiest guy, who's the unluckiest guy. If there's only one, if I see since inception, that means point to point, there's only one experience. You have to, if you have to live the data of 25 years in 20 minutes, then you have to look at all the possible experiences any 10-year investor could have had in that fund. So if somebody, you're looking at the data, you're looking at 1st January 2000 to 1st January 2010. 2nd January 2000 to 2nd January 2010. That's the meaning of rolling. We've also looked at the 5-year rolling return, because 10 years sometimes is not practical. You have a goal at 5 years, you still want to use equity. I can tell you what the kind of risks that has, but I want to not finish without telling you the luckiest 10-year investor has made 32.9% compounded. The unluckiest guy has made 4.9 to be precise. And the most important thing is the odds of beating an FD. See, Indians have a love for 3 assets: real estate, gold, and FDs. So I'm just.
So you've managed to do that.
Yeah.
Beat FD.
Beat FD. How many times did it beat FD? You'll be surprised that 95% times a 10-year investor has beaten FD, assuming FD return was 6%. At least with the tax differential, you can very safely assume 6% has been the average FD return for the last 25 years, because FDs are taxed at 30-35% for most of us, and equity was taxed till 2018 was taxed at 0. So 6%, if that is the passing mark, 95% of the kids passed. That's what it means.
Okay, so Feroze, I mean, we're going to be flashing the names of all these funds, which now have a vintage of 25 years, and you can see the return ranging, right, from the best to the worst. But is this rolling return metric also reflective of which have been the most consistent performers? I mean, only because I don't want people to look at this list and say that, oh, these are the top 5 funds, let me go out and buy them. Is it important to look at just the funds which have come out tops, or the funds which have, maybe in the middle somewhere, but have managed to stay there consistently?
So we can, with this data, answer 2-3 questions. One is equity a great asset class in 10 years? Does your risk automatically get mitigated with time? Is equity a great asset class? That's established.
Yeah.
Is your risk automatically reducing with time, and is 10 years a reasonable time to reduce your risk? Third, which are the funds we should choose? That answer may not be lying here, because I'm looking at all 26 funds. Some of them have been consistently doing well. But yeah, definitely you can dwell deep and identify which are the 4-5 funds which have stood the test of time, which have a huge process in place, analyst team in place, the fund manager thought process is already established. I see so many people running to buy NFOs. I can't fathom yet. In my life, I've not bought an NFO, and my portfolio has done well. And I see thousands of crores getting into a new fund where expense ratio is not established, fund manager track record is not established, his objective is not, his style is not. So the third question, can you dwell deep and see some schemes which have done and stood the test of time? The answer is yes.
Okay, and the only reason I ask this is because, for everybody who's looking at this data and saying that, XYZ fund has been the best performer, but this could also have been because they had 1 or 2 superlative years, somewhere in the past, and that performance has just sort of carried them forward even now. So be sure to look at what makes up these numbers, right? And not just what the absolute numbers look like. Anyway, Feroze is going to stay on with us. We're going to take a very quick break, but we'll be right back and we'll continue analyzing this data and what it means. Hi, welcome back. You're watching MF Corner. With me, I have Feroze Azeez, Deputy CEO of Anand Rathi Wealth, and we've been talking about the 26 funds which have now got a track record of 25 years. What has been their performance? Have they managed to make wealth for investors? And, what does this mean? What does this data tell us about investor performance and investor behavior, and whether or not that is matching with the kind of returns the fund has delivered? So, Feroze, we have spoken about mostly the 10-year rolling returns and how investors over different 10-year periods have done, right? Over there, we saw that there is no capital risk to those investors. You have still made money, even though unluckiest person has made money. But does this risk sort of come into play for shorter periods, say 5-year periods?
Yes, before I go to the 5-year period, I would want to wrap the 10-year discussion, saying that if a person said, I will choose only one fund, not all the 26, then he's taking a concentrated risk of only one fund manager. And then if he held it for 10 years, buying any day and selling after 10 years, none of the schemes have given a negative return to a 10-year investor except one, which is JM Core 11. Right? So only one JM fund has had a 1.5% chance of losing money on a 10-year basis. And it's so commendable. And I think everybody associated with the mutual fund industry should feel proud that if an investor stayed invested for 10 years, in any of these 26 schemes, he has never lost money except in one of them, which is JM Core 11, JM Large Cap Fund. Sorry, it slipped my mind. So that's one. Now coming to the 5-year question, if you reduce the period, the risk goes up marginally. So now if you look at the mean returns, the returns went up. 17.67 is the mean return, average return of 10-year rolling, all 26 funds. The median return is where half the people get more return than that, half the people get lesser return than that, and median is a very important number, 14.99, which is 15. The unluckiest investor for a 5-year period has lost 5%, 5.46%. So somewhere between 5-year and 10-year, your capital risk gets eliminated if this data has to be relied upon. Then if you look at the probability of making more than an FD return is 85%. For a 10-year investor, the probability was 95%. For a 5-year investor, it goes down to 85%. And the probability of losing capital is now not 0. It is 4%. So if you are a 5-year investor, you need to look at this data and see whether this is a risk acceptable to you. If this is acceptable, then a 5-year investment makes sense. If it is not acceptable, don't take the plunge into the pool. It's too warm or too cold, the water.
Okay, but the key message being that over longer periods, you're still better off than pretty much every other asset class. Am I right? Is that the key lesson to derive from here?
Yes, to my mind, Sumaira. I have analyzed at least real estate. I have analyzed close to 500 properties which were bought and till date not sold. Has the funds outperformed 498 out of these properties? The fund HDFC FlexiCap, for an illustration I've taken, have outperformed that property. So with real estate, it has beaten. Indian asset allocation is HNI allocation, I'm telling you after some survey, is close to 55% in real estate, 25% in debt, only 20-25% is in equity. After this show, if we are able to get people thinking to increase their equity allocation from the current 25 average to 35, then I think we have done our jobs.
Okay, if it was one more thing, we're of course looking at some of the oldest funds, right, that we have. If somebody was to watch this show and think that, these have been great performers, wanted to just check how do they compare with, say, the newer schemes, right? If you were to sort of have a model portfolio right now, how many of these 25-year-old funds would you include?
See, in the current 11 scheme model portfolio, which I buy, I get my clients, family, everyone to buy, I think there are about 3 funds which are part of this list. So if they have been there for 25 years, doesn't imply that you have to have them in your portfolio. Even if they have been the best in this list of 26, that still doesn't imply, because mutual fund returns are prospective, they're not retrospective. So if your advisor or your distributor has the analytical capability to identify future performers, which is not statistically impossible, you can better predict future, not perfectly though, better predict the future. So to answer your pointed question, Sumaira, 3 out of the 11 are
no, only because
years.
I want to stress the point that past performance is not a guarantee for future performance. So while we do look at track record, and I would also think that it's a very important metric, it is not the only metric, right? So if somebody is goes fund shopping now, how much weightage do they give to track record, and what else would you like to pile onto that?
See, we have a proprietary model which has a projection. So there are some lead indicators we use, 11 lead indicators, which can tell you whether the fund has a better chance to make performance. So out of these 26, only 3 could make the cut. The second thing which we do is a very rigorous exercise of several people sitting down and finding out target NAVs. So we find out the targets of each stock in the portfolio and evaluate, because targets are always futuristic in nature. Given these 2, I would say that only 3 could make the cut. If I have to name a few funds, I can do that, which are a part of the model portfolio though.
Okay. Why not a Diwali gift?
Yeah, HDFC Flexi Cap, Franklin Blue Chip, which continue to be in our model portfolio, are a good start point for a new investor, especially because that's a large cap, that's a Flexi Cap. In the Contra space, SBI Contra. In the mid cap space, Kotak Emerging Equities. In the multi cap space, Invesco India Multi Cap. In the focused category, ICICI Focused Equity Fund. 6 different categories, 6 different AMCs, almost have 170, 180 stocks in your portfolio. If you buy these, if you cut 6 checks, you have 180 stocks in your portfolio. There is a complementary nature in each of them with each other.
Okay, so Feroze, it's Diwali, and this is the time where people are looking to sort of make changes, and especially where their portfolios are concerned. You want to get things right, for the next year, from this Diwali to next. So what is your top recommendation for investors in terms of, advice? I don't mean a fund recommendation.
See, Sumera, I think Diwali is a good time to rethink and recalibrate the thought process, be it on the strategy side or the emotion side. After having met thousands of HNIs and several retail people also on shows which we do together for the last decade, I've realized that there's a step-brotherly treatment or a step-childly treatment to equity. I just lately met somebody who said that I want to make money in equity in the next 2-3 years. Feroze, what would you advise? Then I asked him, how long have you been holding this extra home? He said 22 years. How long have you held the gold you bought? He said, I buy every Dhanteras and I've never sold. Gold and debt get gold and real estate get 10, 20, 30 years of investment time frame, but the same person wants equity to deliver in 3 years. It's like having 3 children at home, telling 2 children that you can take 10 years to come to 10 standard, but one child needs to get to 10 standard in 3 years. Of course, the child is going to fail. You can't blame the child. The parent has created unreasonable expectation from a child. Have consistency in what you expect out of all asset classes. If we correct that, then India should be reasonably richer than what we are.
And use the same metric to judge their performance as well, if I might add. Feroze, thank you very much for joining in. We wish you, your colleagues, your family, everybody a very happy Diwali. Thank you very much. And with that, we'll wind down on MF Corner, but we hope you have a great year, and do stay tuned to CNBC TV 18.